In this video, guys, let's look at something a little bit different. Let's look at the case for and against buying ARK. Stay tuned. Hey guys, warm welcome to you. All right, so the case for and against buying the ARKK or ARKK Innovation Fund ETF. There's got a few, Cathie Wood's got a few, but this is like the flagship innovation fund and it trades on the ticker ARKK. So Cathie Wood, you know, love her or hate her, you can't deny that she has changed the face of hedge fund, if you want to call it that. I guess it technically is, but the way she's wrapped it up into an ETF, she's been very transparent about the trades she makes. Every day you can get an update on the trades that come through, the buying and selling, the adjustments. It's a different way of approaching things. Rather than the hush-hush, keep things closed, we've got a hedge fund, we're very secretive, and we're only going to have to, you know, we'll only announce the positions that we're forced to by SEC with filings and stuff that come with the legislation. You know, Cathie Wood has said, hey, this is our ideas, this is why we think, and she holds regular webinars as well, which are kind of well worth watching. Regardless of whether you into this or not, it's kind of worth watching to see the mindset of a hedge fund manager. And she's kind of taken out the big layer of fees and she's wrapped it up into an ETF, and it's something like 0.75 cost per year to have this, as opposed to the 2 and 20 that you might get with a hedge fund. Very transparent, like I say, that you can see every day the trades that have been done. And so, you know, it's a really interesting model. It's a really interesting model. Some people don't like her, some people love her. Fine, you know, people have got their own opinions on things. But this video, let's talk a little bit about that ARK Innovation Fund. So as I'm talking, it's down over 75% from highs. So it's getting hammered, right? And this is a theme with tech at the moment. You know, tech is just getting smashed, and innovation stuff is going to be the nature of the model that the ARK Fund has is that they want to invest in things that are big disruptive technologies that are going to change the world or change the way a business is done in a specific industry in the future. And so you're in this situation where they're the ones that are generally the most vulnerable in a downturn, because everyone goes to stuff that's making money, is consistent, has got a low, a low amount of debt on the order book, a low capex requirement, all this kind of steady stuff that can weather storms, because that's what people do. They go, oh, you know, if these guys are over leveraged and they're not making money, and you know they're very vulnerable to a downturn, let's take money out of them. Let's put them into something very, very simple that we understand and know and love, and there's not much debt there. They've been going a while. You know, things like Coca-Cola and all these types of other stuff. We can go through a massive list. Procter & Gamble, things that are just steady chuggers. Not going to do anything massive, but in the day they're probably not going to go bust either. Whereas, you know, some of these companies could well go bust. So that's really the sentiment that's happening, the sentiment shift. And so, should you consider investing in these or trading them slightly different? I'm going to look at them from a kind of more investing perspective, because I think it's kind of, I think this Cathie Wood and ARK is just interesting anyway. So should you consider the case for and against buying ARK? So right, for the disrupting industries, right? It's a play on a big disruptive industry play, basically, and it's spread across healthcare, and we've got electric vehicles in there. We'll go through some of the kind of constituents in a moment, or some of the more weighting stocks in the portfolio. But that's the play you're taking. So that's, you know, I think that's a good reason to take the trade. It's like, okay, it's high risk. You know, I'll put this in the against. It is high risk, but the upside it is good. You know, if one of these or two of these or some more of these come out and really disrupt industries, they're going to be worth massive. You think about Amazon. I know sometimes it's a bit of a cliche comparing some of these things to some of these disruptors like Amazon and Apple, but they completely revolutionized and are now dominating that industry. And that's the play that Cathie Wood is making. She's like, okay, I think these are going to turn into an absolute monster, $1 trillion+ valuation in their industry. And if that happens, then of course, you know, the fund's just going to go do really, really well. But it not always going to be the case. So disrupting industries, negative sentiment. I put this in 4 because, you know, if you're an investor, you generally don't want to be buying stuff that everyone else is buying. You look at these things and go, is it an opportunity? Now, it's not always opportunity because it's cheap. That's a crazy way to look at stuff, because some things are cheap for a reason. But you might look at this and go, okay, there's a real excessive negative sentiment to this stuff at the moment. Now, does that mean that if we just slightly flip positive, if things slightly turn up, let's say the interest rates start to just stall and maybe come down again if the economy stalls? Will that help this? Maybe thinking ahead and saying, hey, yes, the sentiment's negative at the moment. Yes, these things are getting beaten up, but actually, looking ahead, it won't take much for it to flip back around again and become positive. Not necessarily saying that is the case, and of course this is not advice, this video, guys, I'm just looking at things objectively, but that might be a reason to invest in it when everyone's unhappy with it and pulling the plug. If you say, actually, I don't think that's justified, I still think these companies have got a good future ahead of them, I don't think they're particularly in trouble, you might say, hey, you know what, that's a good reason to get these things at a discount. 75% down from highs, so again, I put this in 4, but in the day, if you invested at $50 and it went down to $25, you still lost 50% of your investment, even though it might have been trading at $1,000. This hasn't, but you get the point. It doesn't matter so much, but you could surmise that, okay, these companies have had a valuation that was X, which was significantly higher. You need to make a decision. Was that excessive? Was that way too much? Or is this now kind of fair value, and have we overshot? Because generally, markets, we're only talking from price action, we're talking from valuation, if there's a mean, they're going to overshoot both sides. So if your thesis is, hey, I think they've well overshot to the downside, even just to pop back to, an acceptable valuation might offer a decent return, not necessarily even frothy back up to the frothy last highs. High return potential, so that would be a reason to, okay, allocate capital, say this is high risk. This is not your kind of standard chugging income relating stocks. This is like swinging for the fences trade. Understanding that and saying, okay, that's part of my portfolio. I'm happy to put X amount of capital in that, X percentage in that, and off we go. So against, valuations could be considered still high. Some of these companies are, it's hard to say that they're fairly valued. Some of them are still high, even off multiple things off highs. But again, valuation is very subjective. We've had times when Tesla was considered way high, and actually what happened was Elon Musk did very well at managing to bring the potential of the company and the kind of revenue of the company up to match that valuation, and go, hey, actually, hang on, you know what? We're doing all right here, rather than it struggling and the valuation coming down to match it. So, who knows what happens with that? It's high risk. In a day, these companies could go bust, and that could decimate the fund pretty massively. But that comes with the high return, right? You never get high returns with low risk. And you could say it's pretty overweight on stuff like Tesla. So if you think Tesla's perhaps overvalued, for example, you might be like, well, you know what? I'm 10% of the holdings in Tesla. Do I really want that? Now you can actually strip that out. If you want to invest in ARK and invest in all the companies they've got in ARK, you could go short Tesla as well to almost strip out or reduce the exposure. You can play that game. You can buy ARK ETF, take a little bit of Tesla short, and just reduce the exposure that you get. You have to work out in your head how much exposure you'd have to Tesla with the position you've got in ARK. Easily done, and then take a short position to neutralize that exposure, and it will just dampen down that. If you want to go down that route, that might be able to complicate things. That might be a reason why you say 10%. That's often the case with these ETFs, guys. Is that very often they have some really good ideas, and then the rest of it is just like almost a filler. Difference with Cathie Wood, I have to say, is that she does kind of spread things a little bit more evenly. Some ETFs, you kind of look at it and go, well, yeah, it's 75% in one, 20% in the other, and then you've got all these other companies where you've got 1 or 2%. You think even if they treble, it's just not going to have any impact on it whatsoever. Whereas I think, give her credit for that, even though 10% seems a lot, and you kind of got overweight Tesla quite a bit on it. Some of these others here are still 8%, 7%, etc. And even some of these ones, look at the top 10, 4% on the 10th. These are all 4%, which is still reasonable. So it's not too bad. It's not as bad as some ETFs, but it might be a reason not to take it. So top 10, we've got Tesla, Zoom, Roku, Exact Sciences, Square, Teladoc, Twilio, Path, Crispin Therapeutics, and Coinbase. So these are all pretty disruptive companies, right? Zoom's all about Square, payments, Teladoc, the healthcare, Twilio, the cloud-based SMS type services stuff. Anyway, so you are betting on innovation. You are betting that some of these companies, and not all of these would have to do really, really well, but you can see how the price has moved so much. But if the sentiment shifts back into positive again, and some of these really start to pick up, and some of these are beaten down massively, like Parts beaten down massively, Coin, some of them are really, really hit hard. Even Zoom, to be honest, is trading under $8 last time I looked. And so your objective when you're assessing this is to say, okay, what's the weightings? What do I think about these companies? Are they positioned well to disrupt? What could happen if they did disrupt? Where could these potentially go over the next multiple years? And look at it almost like a venture capitalist fund and say, okay, there's probably going to be a few losers, but the point of this is that if Cathie Wood picks, you know, a handful or a couple of really big winners, how is that going to affect? You know, so if these were, you know, some of these, say 3 of them went up by 10 times, you know, 20 times, 50 times, what will that do to the fund? That's kind of the play you're taking when you're buying ARK. But then obviously the flip side is that, hey, have they had their day? Was there a load of froth in the market? Overvaluation? We're never going to get back to those highs. And even if these guys do manage to disrupt things, they're never going to get to the point where they are absolutely dominating in their multi-trillion dollar companies, multi-trillion dollar market cap companies. That would be the argument that you have for not buying ARK. But hey, who knows? It's interesting. I like watching this stuff, and I especially like what thing Cathie was doing with the transparency in the webinars and all that type of stuff. I think even if you're not involved in investing or not involved in stock picking as such, from a trading perspective, from seeing how high-level managers operate, it's interesting anyway. Take care, guys. Keep your risk managed. See you in the next one. Bye-bye.